Hi there. Thanks for tuning in. Today we're going to be doing an analysis and valuation of Molina Healthcare. So let's just get started. I want to make this one respectful of your time. So, how do they make money? So, first of all, they're a Fortune 500 company, pretty big out there. They provide managed healthcare services under Medicaid and Medicare programs. So, they essentially provide health insurance under Medicaid and Medicare. Medicaid is if you are less than 65 years old, Medicare is if you're more. And then through state insurance marketplaces, or also called the marketplace, these are plans such as, for example, Obamacare, which are given to people that make too much income to qualify under Medicaid or Medicare. And Molina was founded a while ago, but they've grown a lot. They operate in a whole lot of states, 20 states in the US as of December 31st, 2023. So, yeah, pretty big health insurance company. Their business profile here, you'll see that Medicaid is the grand majority of what they make. And that makes sense. I mean, that probably serves the grand majority of Americans. They're out there navigating the American healthcare system. It can seem a little confusing, kind of because it is, but yeah, I mean, they essentially help link people with those programs that best qualify for them. And they actually, unlike other health insurance companies, tend to serve lower income customers. They tend to be in areas that have a higher concentration of lower income people that need health insurance, but don't know how to get connected to those government programs. That's where they come in. Now, the overall picture here, the long term view from 2014 to here now is that they're a very high grower. I mean, look at these monster revenue growth numbers, right? Most of them are double digits, with the exception of a few down years, and then 2023, which is single digits, but still, that's monster revenue growth. Even their gross margin has been pretty decently above the 10% level. Their operating margin is a little lower, but still pretty good, hovering around that 5% level nowadays, which has improved greatly from the days before. And the return on assets, return on equity, and return on invested capital, even as revenue has grown, so has this number pretty much. And that's what we like to see. That also means that even though your money is growing, you're still keeping a lot of it, and whatever you reinvest is still returning you even more dollars. So if you have growing revenue, growing profits, and growing return on invested capital, you are in for a good time. Also, we are going to look at revenue estimates here from Yahoo Finance. I mean, they provide analyst estimates for the next year and the year after that. So for 2024, they say they're going to make $39.49 billion dollars, and then for 2025, $41.59 billion dollars. Okay, that's fine by me. I am basically going to convert this to a discounted cash flow model. I'm going to say about 5% of these numbers of 39.49 and 41.59 is going to be turned to actual free cash flow. This is in line with their historical numbers. And even then, because this represents monstrous growth from the year before, this is going to be a lot more cash flow going forward than they've been dealing with before. So it's still a generous projection. I think it's fair enough, right? But anyway, with these numbers, if I put a required rate of return of 12.5%, which I'm putting because of some uncertainty, right? The government is changing. You don't know how they're going to fund those programs. You don't know if they're going to change them at all. So I think if you're considering having, I don't know, a 7.5% or 10% rate of return, you can do it in two different ways. One of them is you can put a margin of safety on top of the valuation you get. The other one is you can increase your required rate of return. Either will do just fine. You don't double count though. Just make sure of that. But yeah, so I'm increasing here my required rate of return. Usually I require around 11%. Now I'm requiring 12.5%. I may require more, but with these assumptions and with a perpetual growth rate of 3%, I'm going to say in 2026 and 27, they're going to grow 5%. And from there onwards, they're just going to grow 3%. I think this is highly likely. I mean, it's highly likely that they do even better given their numbers before and given the fact that people will always need health insurance, period. Well, if you divide that by the total number of shares out, you get a fair value of equity of $390.07. But if you adjust for the debt, which they have net cash really, it's not that they're debt free necessarily, but they have debt and they have a boatload of cash that they manage, which makes sense. They're an insurance company. I would say that their value post debt is $428.58. Now, because they're an insurance company, discounted cash flow can be an interesting method because at the end of the day, their business is a little different. So I'm going to look at another measurement. That's the price to book value chart. And in general, their book value is a lot lower now than it has ever been. I mean, it's back at 2020 levels here. It was basically double what it is right now. It's around 4. Before it was pretty much around 7 or 8. So you like to see it. You like to see them trading relative to the value of what's in their books, to the assets that they have in their books, a little lower. In the case of liquidation, that means a lot more money is given back to you as a shareholder, really. So, Molina Healthcare, their price right now is around a little less than $300, P/E ratio of around 15, a market cap of 16 billion. I think it looks decent. I mean, as you've seen, it has had a pretty stratospheric rise. I think this is fair. Their revenue has gone up stratospherically, and I do want to talk here about how much it jumped from 2020 to 2021. Of course, part of it was the fact that people were subscribing and required by where they lived in the States to subscribe to a Medicare or Medicaid plan in light of the pandemic. However, this has been something that they've managed to capture. They managed to not only capture this, but retain them and reinvest that money and grow. So you like to see companies that can reinvest properly and use that to grow further. This is what Molina has done, and I think they've done it very effectively personally. So, in light of that, I think this company is not bad. Valuation looks really solid and shows how insurance generates boatloads of cash flow. I mean, they generate a lot of cash. They can use that for acquisitions, which they have. They can use that to give a dividend back. They don't, but they do give you a bunch of share buybacks. So, yeah, this shows increased investment and expansion with share buybacks, which should return a lot of money to investors in the long term. It certainly has before. Now they've come off a peak, but I do think it could still represent an opportunity. They also have a massive cash balance that they can use to pay off any debt or pay for acquisitions. But the American healthcare system is something so complex, you have to be willing to follow the macro policy portion of it or account for uncertainty, right? Which is kind of what I tried to do in this valuation, but it could be worth putting even more of a premium on that one, putting even more of a margin of safety because it can change at any point, right? Or because the rules, and it doesn't have to come from the president, it can come from a judge somewhere that just changes the rules of Medicare and Medicaid. So you're taking a risk. It's not risk free. However, you are looking at a very interesting company trading at very interesting multiples. Just from multiple expansion, just from growth and the reinvestment of that growth, you can probably generate a decent return. So at the end of the day, look for solid businesses that you can understand. If you think you can understand Molina Healthcare, and if you think this is a solid business, which I think I've shown, then this could be for you. But if you can't understand it, if you're not willing to follow through with looking at the policy, reading all the earnings reports, then maybe you should look elsewhere. So it's just going to depend on your risk appetite, but I think it's a very interesting opportunity to look at. Now, thank you so much for watching. I appreciate you watching all the way through. If you have any companies you want me to look at, please comment down below. Thank you so much once again, and have a great rest of your day.